Welcome to the Asset Coach and Tax Strategist YouTube channel. If you're a subscriber, thanks so much for subscribing. If you're a first-time viewer, thank you for spending your time here with us. If you like our content, please give us a thumbs up. For you new folks, Asset Coach Tax Strategist YouTube channel is based on the book Economic Termites. This is a book that I wrote a few years ago talking about taxes, inflation, time, laws and regulations. Also, I wrote a second book called Farming Assets. Those two books is really what this whole channel is about, addressing those situations and how they affect you and I in our ability to grow our wealth. So as an asset coach and tax strategist, my name is Robert Wolf. I am the CEO and founder of Terra Firma Business and Financial Consultants and its affiliates. We have a bunch of companies that we've built out this ecosystem surrounding the basis of what we talk about on this YouTube channel. So if you're not a subscriber, hit that subscribe button. We drop episodes every Thursday. Again, if you are, thanks so much. And let's get into this next episode. All right. Welcome back to another episode of Asset Coach and Tax Strategist. And so what we want to do at this time of the year is, it's a big conversation we have with a lot of our clients and members, is asking about tax harvesting. What does this look like, right? Everyone's looking to lower their tax bill. And this is the time of the year that everybody does it because we've had 8, 9, 10 months. And now we're at the last part. We kind of have a good idea what our income is going to look like, what our profit in our business is going to look like. We also have an idea what our investments look like. And so we're going to start talking about this conversation that we hear a lot of times in the investment side with typical financial advisors and brokers, where we call it tax harvesting. And what's tax harvesting? What's this look like? So what I'm going to do is I'm going to pull up Chat GPT, easy for you to say, and I'm going to ask the question, what is tax harvesting? And I'm going to answer this for you, but then what I'm also going to do is acknowledge the very simplicity of how the rest of the quote unquote investment world utilizes this term tax harvesting. Now, I want to make sure it's very clear. I am not giving investment advice. I'm not making any recommendations. I'm not making any solutions or suggestions. All I'm doing is providing educational information and giving you an ability to think outside of the box that has been given to you so far. So again, this is not tax advice. This is not investment advice. We are not giving legal advice. This is just for educational purposes only. So what is tax harvesting? So if you go open up your Chat GPT and you type in, what is tax harvesting? It'll pop up and it'll say tax harvesting, often referred to as tax loss harvesting, is a strategy used by investors to reduce their tax liability on capital gains. Okay, so what's capital gains? So you invest money into an investment and it grows. And you sell that investment, that appreciation, that growth from your investment principal to what you sell it for, that difference is a gain. Now, it's called a capital gain, okay? And so there's two capital gain markers: short term, which is less than 12 months, long term, which is beyond 12 months. They're taxed differently, okay? So the basic concept of tax harvesting is that it involves selling investments that have lost value in order to offset assets that have gained values. So you have let's say you have a loss of $10,000, okay, meaning that you invested money and the value of that is below what you invested by $10,000. And then let's say you have another stock, for example, that you invested amount and it's $10,000 above that. You made that $10,000 gain, okay? You sell the loss and you have a $10,000 loss. You sell the gain and you have a $10,000 gain. You subtract the two or add the two from each other and it nets zero. So you create liquidation of those two assets, those underlying investments, and now you have the liquidity, but no taxation. You were able to take your gain and you're able to take your loss. And that's an example of the kind of a break even. But what happens if you're in a situation where you don't have losses? The market has been going up. You've been investments, and the investments that you invested are appreciating. They haven't gone down. You don't have any other assets or investments to offset that. What do you do? Well, some will say, well, that's a good problem to have. But the problem is it's a problem, right? So what happens in the traditional investment world is that if they can't do tax harvesting, what do? Well, they don't sell the underlying investments. Why? Because it's going to create a capital gain. And what do we not want to pay? Taxes on a capital gain. So what do? Nothing. We just let it sit there. We let it lie. And if the asset can or the investment continues to grow, what are we building? The same issue. We're just expanding on the issue. Okay. Now, I find that to be an issue, right? The whole point of investing is buy low, sell high. In most people, when you ask them what kind of rate of return they want to get, they'll obviously will say, well, as much as I can. But when you actually truly say, okay, what are you willing to lose? They'll tell you a dollar amount or a percentage, and then what kind of gain do you want or you're comfortable with? And most will give you an answer. So let's say 20%. It'd be awesome if I got a 20% return. Well, what happens if you have an investment that has gained beyond that 20%? What do? Well, most advisors, they pat themselves on the back and said, see what I'm doing for you. Or most of the times when we do our own investments, now we're beyond that 20%, we're at a gain. And what are we concerned about is the taxation on that now. So remember, it's just a paper gain. It has not been realized because we have not sold that asset. So it is all just paper funny money. The only thing that is a real dollar, a real number, is what you actually put into it, your principal. That's for real. Everything else is fake until you actually execute it, meaning realized until you execute it. Now, Bob, that's not fake. My account says this. Well, obviously it says that, but you don't have that because you haven't sold it. It's not sitting in your bank account. It's just sitting in a brokerage account, just lying there and sitting there saying, this is how much I have. Okay. So what happens to folks that have appreciated, and what if that company eventually goes bankrupt? You find out that there's some issues going on and it goes bankrupt and you lose everything. You lose all the gain, you lose all the principal that you put into it. What happens then? You didn't realize the gain. You just wasted time. Time is a currency. I've said this in previous episodes. And so when we don't acknowledge time as a currency and we don't liquidate some of our assets and some of our investments that have the gains that are beyond what we've actually are happy with, and we're fearful now of the capital gains tax, then what we do is we sit there in this kind of limbo, and now we're eating away at our currency of time. Okay? And that's a problem too. So having the liquidation, having the capital is very important. So here's one suggestion that we may want to look at when it goes and it comes into this tax harvesting idea. Again, traditionally it's about brokeraging. But what if we looked at real estate? What if we looked at alternative assets? What if we looked at other areas within the tax code, within what you're trying to accomplish? So let's say that you have an LLC that you've set up. This LLC is kind of like the family LLC. You guys put some money into it and you use it to invest in certain like side hustles, that sort of stuff. Okay, and you do this as a somewhat of a layer of protection, right? So things aren't in your personal name; they're in the business name. Now, most real estate is put into an LLC, right, from a liability perspective. And so, if you were to start a business, what would be recommended? Most attorneys, most CPAs, good CPAs, will recommend that you set up a entity and put that business in an entity because of a liability protection. Now, a lot of CPAs will say, well, if it's not earning anything, why go through that hassle? Well, it's not a hassle. That liability protection is very valuable. And you only know that that liability protection is valuable until you end up having a liability. And now you're personally being sued for issues that you could have protected by having that simple little LLC, whether you're generating revenue or not. So that's one of the things we need to look at. But let's say I have a stock portfolio, and let's say I have $100,000, just as an example of gains, and that's my gains. So that's above my principal amount that I put into it. And let's say I put in 20 grand. Okay, and now I have 100 grand in gains, so I have 120 as my balance, and I'm sitting there going, I'm pretty excited about it, right? I made money, buy low, sell high, right? It's the whole basis of investing until we make money, and then we're like, ooh, maybe I don't want to pay taxes, right? Again, that fear mongering comes into play, and we're concerned about that. And most advisors don't look at the taxation of a particular return and offset the taxation on that return to show that, well, I got you a 15% return, but after taxes it's 13% or 11%. They don't usually look at that as just whatever. Okay. So this is an important thing, is because we want to create that liquidation because we bought low and we want to sell high. We want to realize that gain, acknowledge that gain. So what do we do with those funds? Well, what happens with a lot of brokers is that they just sell and then they go buy more stock, right? They're just very tunnel vision, but that's their business. That's what they do. But if we were to take a step back and let's say you do have some real estate in hand, okay, and we'll just use real estate as an example because it's an easy conversation that a lot of people, especially my listeners too, have access to real estate or invest in real estate, and or have an idea of what the desire or the goal of real estate is, and from an investment perspective. So let's say you decide to sell that that underlying stock. So you sell it, you now have 120,000 sitting in your bank account. Okay, 100 of that is capital gains, right? So you're going to pay taxes on that. So let's say you're in a 20% tax bracket, you're going to pay 20 grand on that. So basically your original principal amount. Okay, so you're going to have a net 80,000 gains. So why are we scared to pay 20 to have 80 in our pocket when we put in 20? That's still a 4x, right? Why are we so fearful of that capital gain? But now that we have these dollars, when do you have to pay that capital gain, by the way? It's when we have to file taxes. So what do people do? Is they always do tax harvesting at the end of the year, right? Well, what if you just did your tax harvesting in January? And because you don't have any losses, but we liquidate those capital gains in January or February. When do you have to pay the taxes on that capital gain? When you file that next year's taxes. So we're in 2025 at the time of this recording. We're in October, the end of October, going into November. And let's say we're going to hold off till January 15th of next year of 2026, and we decide to sell and take the gains. Now we have all the way until 12/31. We don't pay the taxes then, do we? We recognize the income at 12/31. But when do we have to pay the taxes on that? When we file our tax return. And typically when we file our tax return, most of our clients and most of those that we work with, we file extensions. So let's say we go all the way to October 2026. That's almost an entire year to do what? No, it's not an entire year. If we did this in January, we have an entire year and then another 10 months. So it's a year and 10 months before we recognize and have to pay those capital gains. So think about that. Right now, people are tax harvesting. They're trying to do all this stuff. They're trying to liquidate their gains, all this kind of stuff at the end of the year. Okay. But most of the people don't have these gains. So just waiting 2 more months and then you extend all the way to having 20 months till you pay the next tax bill. Essentially, you file your extension. Think about that. So in that period of time, if I were to liquidate and all of a sudden I have my 120,000, okay, and what if I use that 120,000 to now go buy real estate as an example? What would happen? Well, usually 120 is as a 20% down payment. That would get you a $600,000 of real estate leveraged, right? 20% down payment, 120 is a 20% down payment. We can get 600,000 of real estate. Okay. Now, you're not a real estate professional. We're not going through those designations because I know some of you go, well, Bob, I can't take the tax benefits if I, no one's saying anything about tax benefits, are we? We're just saying actually liquidating, uncorrelating your existing assets into another asset that creates a value that also appreciates, that also you end up having renters that pay off that. Right now, you're paying your own investments. And so if you had real estate as an example, and all of a sudden that real estate is being paid for, your equity is growing, it's appreciating, and you do get to write off expenses, by the way. You just can't realize all your losses, but you can carry forward those losses. All the real estate professional designation means is that, can I take these losses today on my tax return? Doesn't mean you lose those benefits. You carry forward those benefits. So what's that mean? That means that if I want to take these losses on my real estate, I carry those forward and I end up selling that particular property, or I have other real estate and I have gains in that real estate, the whole bucket gets to offset each other. So now I can tax harvest in my real estate, if you will. Here's the thing about the IRS as your business partner. If you have a loss personally or business-wise, you don't lose it. You get to carry that forward. In fact, the IRS was so generous that there was a period in time in business you actually got to not only carry forward, but you got to carry it back. And so you could use that loss to offset previous gains and get a refund. They stopped that, and now it's carry forward, which I think is completely fair. So building that reservoir of loss is very vital strategically because of this whole tax harvesting conversation. Your assets can create reserves of future. I have some members that we work with that I look at their Schedule D, and they've got $100,000, $200,000 of losses sitting in there that they're carrying forward at $3,000 a year. But then at the same time, they're sitting on capital gains in their brokerage accounts long-term that they're just sitting on. It's like, look, if you got 200,000 of carry forward losses, you can actually create 200,000 of gains to liquidate and you offset each other. Tax harvesting is not just about your stocks, bonds, mutual funds, ETFs in a brokerage account. Tax harvesting is a strategy on assets, on capital gains, or on assets, not a just particular asset. They're on assets. So having this holistic viewpoint and this holistic approach of what this looks like, and also not being, trying to be focused and fearful of, oh, I got to make these decisions before the end of the year. How about we be strategic, and when we create that liquidation, we do have that cap gain. How about we be strategic in doing it in the beginning of a year, so we have time as a currency to be able to generate liquidity, have that liquidity to generate returns, cash flow that could end up paying for that tax capital gain. So this is the value of tax harvesting. This is the value of understanding assets. This is the value of multiple diversification of assets. We call it the asset buddy system. How do we use multiple assets that we are able to use in a holistic plan? And in this real estate portfolio, this is your conservative portfolio. If I have cash value life insurance, it's part of my conservative safe money. Could I take more risk on my stock portfolio? Yeah, I could, because I have this part of my portfolio, my investments, that are my safe money. So I could create a 30-40% rate of return with some of these stocks and take a little more risk. Now, you can't do that, and most advisors won't allow you to do that because they're managing that bucket of risk. So they're looking at your risk tolerance on that bucket and not your other assets typically. Okay, and again, I'm not giving investment advice. I'm not giving tax advice. I'm just throwing some educational information out there to make you think and wonder, what's this mean to me? How can I do this as well? So hopefully this was helpful. If you have any comments, go ahead and drop those down in the comment section. If you like this content, give us a thumbs up. We appreciate it. Or even subscribe if you haven't subscribed. We drop episodes every Thursday. So thanks so much for being here. Make it a great day.